Welcome everyone to part two of our tax Q&A for Enum Palisade survivors. Thank you all for joining us. Many participants told us that the chat during the last session was distracting, so tonight we've turned off the chat and we ask that everybody submit questions through the Q&A function instead. Thank you as well to everyone who submitted questions in advance. We received hundreds, and we will work through as many as we possibly can. We're grateful to Public Counsel and especially Stephanie Carroll for partnering with us on this event. And we're also delighted to welcome back CPA John Trapani, who is here by popular demand. Cherry Lee will be moderating tonight, and Wanda Dorgan will be joining her. And I'll now turn things over to Wanda.
Thank you very much, Sandra, and welcome everyone. What Cherry and I are going to do is give you some semblance of calm in what is a very complicated area. And, unlike we're all familiar because we're all survivors with what it was like right after the fire and needing to know about SBA loans and needing to know about insurance claims in that process. And the Eaton Fire Survivors Network was so critical in our understanding how to go forward. With this stuff that's so complicated, we're going to try to help educate you as best as possible, but in my opinion, everyone is going to need a tax specialist to work with to get through all of this. So we're going to do our best, and we've broken this down into 4 areas. The first is going to involve tenants and tax concerns with respect to them. The next is total loss survivors. After that will be standing home survivors, condo owners, and to the extent that we have time, business owners. Now, as Sandra mentioned, it got kind of crazy with the chats going on and all the questions. And we do want to honor any questions any of you might raise. And so in the sense of wanting to bring some calm here, we would ask, listen to your particular area, whether or not you be a tenant or a total loss survivor or whatever. Listen to all of it and then pose your question in the area that's designated for questions, because I think it'll be better for you to try to understand it all before you pose the questions. Now, for you that are total loss survivors and standing home survivors, there's going to be some overlap. So wait to post your questions until after both segments are done. Joy will be sending out some handouts that I think will be very beneficial to everyone with the next newsletter coming out Tuesday. So you may want to wait for that as well before throwing up your hands and deciding you don't know anything. So we're going to make this kind of conversational with John so that it's not quite so intense and that a lot of you get the answers that you need. Many of the questions that were submitted are duplicative of what was already covered by John, but he's happy to tell you as many times as you need to what you need to know to just have kind of a basic working knowledge so you can feel more comfortable. Now, there are a couple of questions that pretty much apply across the board. The first one was already asked, but we're gonna deal with it again anyway. And that is, are grants reported on a 1099 taxable? As we mentioned at the last, or someone mentioned at the last seminar, people are getting 1099s from LA County for grants that were bestowed upon them. So John, if you could answer that question, please.
Yes. Well, first, good evening to everybody, and thank you for having the opportunity to come back and talk again. It's a pleasure and an honor. So I've done a little bit of more investigation with regard to these grants and found out some additional information. First thing I found out was that the county, on their website initial offering, they specifically said that they're not taxable. And then, of course, they send out these 1099s. My judgment is that they should not be taxable. I'm not the IRS, so you can't rely on that as an excuse. But I'm pretty pretty sure they're just should not be taxable. Now, you do have a 1099, so that 1099 does have to get on the tax return. Otherwise, you're going to get a nasty note from the IRS when they do their 1099 matchup. So under miscellaneous income, you report it as the organization that you received the 1099 from and report the amount. And then right below it, on the line below it, you indicate disaster recovery, non-taxable grant reduction, and then a minus number so that the two numbers net to zero. That's the way I would suggest. Now, with regard to the support that was coming from the state for mortgage payments, that I think is taxable. It would just get reported as miscellaneous income.
Thank you, John. And speaking of mortgages, many survivors have put insurance proceeds into an escrow account because they've been forced to do so by their mortgage companies. So the question that relates to that is in fact that reportable and taxable?
You mean the proceeds that have been received?
No, I'm sorry, the interest on it.
The interest. The interest that's received on those escrow funds is taxable. If you had money that excess additional money and you put it into your brokerage account or bank, whatever, and you're getting interest on that, that's just taxable.
So John, what if someone never receives a 1099 for that interest? That's part of that escrow.
Well, that doesn't relieve them of the responsibility of paying tax on it. But I would guess that they should have gotten a 1099.
Okay. So let's move on to tenants. And
Lisa,
somebody's got their mic open.
Jack Kaplan just you're supposed to get something about like what they need.
Please mute your.
Can someone mute their? Okay. I think we're good now.
Excuse me.
Wanda, you are muted.
Okay, with respect to tenants, John, what do tenants need to know going into tax season?
Okay, well, you could be a tenant in two circumstances. This could be your primary home, in which case everything that we've said about primary residences applies, except the real estate part, because you don't own the real estate. So you're getting money for contents tax-free, getting money for additional living expense, and that gets offset by any actual additional proceeds that any additional money that you might get or that you're paying out over and above what you receive. If this is not your primary home, and maybe you're on a temporary assignment and you rented a house and you live in Oakland or Denver or someplace, well then the contents money, you probably didn't bring a lot with you in terms of your contents. So but any proceeds that you might get in that case would be you'd have to report it. Excuse me, I'm saying, made a mistake there. You have to disclose it, and you'd have to you could just defer the gain on that as well as long as you replace or acquire personal property in a like amount. Now, if this is all kind of contents money, contents that you didn't get as much as the fair market value of that property, then you don't have a gain. And so I would just make a statement in the tax return saying that we received money for contents and it's offset by the fair market value of the property at the date of the loss.
So John, you mentioned you used the term tenant in a primary residence. Are you talking about someone who may be renting from like a parent?
No. I'm saying that instead of owning a house, I rent a house.
I see. So you're
I'm,
using the term
that's my
primary
permanent,
residence.
that's my permanent home was,
I
was,
see,
was the property that I was renting.
as opposed to being someone from out of state being here temporarily or whatever.
Correct,
Okay.
correct.
So that segues into, we use the term tenants broadly. Some people do have formal signed leases. Others are living with relatives, which might include their parents. They're paying utilities, or there's some other informal arrangement. Does having a formal lease versus an informal living arrangement change anything tax-wise for tenants who are victims of this disaster?
Well, so let's say that a person is, living with their parent, temporarily living with their parent. So they probably, one, they don't have a lot in the way of personal property. The parent, the owner of the property that they're living with, probably has part of their personal property coverage includes personal property owned by people that are not, how should I say this? So I've got to put this in different terms. I own the property and my son is living with me. House burns down. My insurance policy should have coverage for my son's property. So I would make a claim not only for my own personal property, but for my son's personal property. And his personal property would be tax-free. Mine would be tax-free.
Okay. Now, some of this was already covered, John, but we're going to ask again just for
No
clarity.
problem.
Can tenants claim a casualty loss if their personal belongings were destroyed?
Theoretically, they can, but it is really tough to get a casualty loss on personal property. And we're not getting into numbers tonight as much as we can delay that or keep from doing that. But my experience is it is very tough in terms of the way the calculations work. It is very tough to get a casualty loss on personal property.
Okay, if a tenant did not have renter's insurance, can they still claim a casualty loss?
If they did not have renter's insurance, then, and they're not getting a claim, making a claim against Southern California Edison, yeah, they can claim a loss, but it would be at the fair market value of the property, not the cost basis, but the fair market, and not the replacement cost, but the fair market value. So, I bought a suit for $500 3 years ago. Well, it's no longer worth $500. It may cost $1,000 to replace it. My casualty loss is probably going to be on that suit is going to be maybe $150.
And when you use the term cost basis, what are you referring to?
What I paid for the suit.
Okay. So are relocation payments or rental assistance taxable?
I'm not sure exactly what you mean. You mean
Okay.
for the renter?
For the renter, for the tenant. We're still on
For
tenant.
the tenant? No, I don't think so.
Okay. If a tenant received assistance from a landlord, nonprofit, or utility, is that taxable?
Well, if they received, that sounds like a grant, and I would say it's not taxable.
Okay. Can a tenant deduct unreimbursed moving expenses?
No.
If a tenant is still displaced in 2025, does anything need to be filed now?
You mean in 2025 or 2026?
I think that, well, this question was framed as 2025, but I think it's more applicable to being still displaced in 2026.
2026.
So thanks
Yeah,
for
I
catching
would guess that there's nothing for 2026.
But going to that question, if a tenant is still displaced in 2026, does anything need to be filed now for 2025?
Well, if they received money for their contents, then and this was their their permanent residence, their principal residence, then I would suggest that they just add a note to their tax return saying that they received the proceeds and that this was their primary residence and they're tax-free. As to any money that they received for, I'm going to call it additional living expense, then to the extent that they incurred additional living expense, then now that gets a little tricky because they're no longer paying rent. And so now, but they may be paying more rent than they were paying before. So that incremental amount, I think, would be offset against any insurance money that they get for additional living expense. But they might end up, it's possible they might end up with some taxable income.
Okay. So I just have one more wrap-up question before we go on to the next area. And that is, what documentation should tenants be gathering?
Well, the insurance proceeds, again, assuming that this was their primary residence, they just want to have maintain the records of their insurance proceeds that they're going to be disclosing on the tax return. And I say disclosing, not reporting and paying taxes on, but just disclosing in a note to say we received these proceeds and they're not taxable under, and you can quote this, under Internal Revenue Code section 1033 bracket or parenthesis, small h, close parenthesis, open parenthesis, 1 close parenthesis. So it's 1033 H1.
Thank you, John. I think that tenants will appreciate that. So now we're going to move on to total loss homeowners. And a lot of this, again, is duplicative, but it's put in order so that there can be a little better understanding about how it relates to those of us, including me, who are total loss homeowners. So let's start with number 1. I already know the answer to this one, but John, I'll let you answer it anyway. Should a homeowner wait until all insurance and litigation proceeds are finalized before claiming a casualty loss?
Yes.
And why, John? Because I think the why is very important.
Okay. So the code is very specific. It says that if you have a casualty loss, if you think you have a casualty loss, you have to wait until you have received or you have resolved, settled, adjudicated, or abandoned all claims for compensation. So you have to know, one of the numbers you need to know in terms of figuring your casualty loss is how much money did you receive? And if you've got open claims, then you don't know how much money you've received. So you cannot claim the casualty loss until that number has been resolved.
Right. And as you've explained very clearly to me, if you claim a casualty loss too soon, you're trying to unwind it later on, which might cause you to pay more in taxes than you otherwise would have, correct?
Yes, because you're getting the benefit of the loss, any loss that you claim, by reducing your existing taxable income. So you're kind of running down through the tax rates. But when you recover that amount later, then you're adding that to your taxable income and you're paying it at higher tax rates.
Great. Good segue to the next question. Can a previously filed casualty loss return, such as for 2024 and 2025, be amended later?
Technically, no.
Technically, but what is not technical?
It gets more complicated than I could get into right now.
Okay. So do it right the first time.
Right.
Okay. Does federal disaster tax status extend the replacement window for involuntary conversion from 2 years to 4 years? And I hope people retain this answer.
Okay. Partial answer, yes. Complete answer. First, you have to determine what year you first have a gain. So if your proceeds exceed your cost basis in 2025, and you're a married couple then, and you meet other qualifications, you could deduct from that gain that you now have $500,000. If after deducting that $500,000 as of the end of 2025, you no longer have a gain, but now in 2026, you receive additional proceeds that exhaust the rest of that $500,000. And so now in 2026, you have a gain, then 2026 becomes your gain year. And now you've got 4 years from the end of 2026 to complete the process. That gives you to the end of 2030. If, on the other hand, you have a gain in 2025, then you have until the end of 2029.
So
By
John,
the way,
please give us, I'm sorry, go ahead.
oh, I just gonna say, by the way, if that's not enough time, then we can apply for. I've applied for many extensions of those replacement periods and never been turned down. And in one case, I think I've asked for 5 extensions.
For how long a period of time?
Well, they only
Overall.
give an extension for 1 year at a time.
But overall, what were you able to manage to get for the taxpayer?
It's like 9 years,
Oh, my goodness, that's
10
amazing.
years. Yeah.
So John, for the sake of the audience, can you please give us a simplified example of what you just said? In terms of, okay, they spent X for the house, X for improvements, got this much in insurance, et cetera, et cetera.
So let's say that you've got $200,000. I'm going to make the numbers manageable. Let's say that you got $200,000 invested in the property, in the house, land, improvements, rose bushes, landscaping, everything. Okay, that's your cost basis. And let's say that you receive in 2025 for the real property under all of the various coverages for real property. So it would be coverage A and coverage B in most policies, debris removal, trees and landscaping, code upgrades, maybe extended coverage. Let's say that you receive $1 million. So $1 million compared to 200,000, you've got an $800,000 gain. You're a married couple, you've lived in the house qualifying period, which would be at least 2 years. You've owned it for 2 years. You haven't used the provision for 2 years. We can write off the top $500,000. So the $1 million now becomes $500,000. 500,000 compared to the 200,000, we have a $300,000 gain. So this is all happening in 2025. So that would be the gain year would be 2025.
Okay, and then you'd have 4 years after that. Mm-hmm.
Right.
So give us the opposite example, John, in simplified terms, where there wouldn't be a gain in the 2025. Yeah.
So in 2025, instead of receiving $1 million, they only receive 400,000. So 400,000 compared to the cost basis, maybe I'll make that 450,000, make the numbers more understandable. They receive $450,000 in 2025. Now they've got a cost basis of 200,000, $450,000 of proceeds. They've got a $250,000 gain, but they have that $500,000 exclusion. So that brings them down to zero for 2025. And the 4-year clock has not started.
Right.
So now we get another $300,000 in 2026. Well, that now we had $250,000 that we used of the 500,000 in 2025. That leaves us with a remainder of 250,000 that we can apply against the 300,000 in 2026. And so now 2026 is the gain year.
So the 300,000 could presumably be an Edison settlement or something like that, right?
Well, yeah, but let's leave that as a separate issue.
Okay.
Because that has other aspects to it. that may or may not be. Hopefully, we can deal with that on a separate basis.
So with that last example that you gave, John, that shows that there was not a gain for 2025, and there was additional money in the amount of 300,000 received in 2026. It is possible then to split that $500,000 exemption between the 2 years.
Oh, yeah,
Correct?
yeah, yes. It could be over 3 years or 5 years. It just
Okay.
sits out there and you use it as you need it.
Okay,
Sorry,
that's good to
John.
know.
So just to clarify, when you talk about the cost of, say, that 200,000 for the house, so that's when how much people paid for the house plus any upgrades, remodel,
Right.
right? Okay.
And it would include, lemon trees, rose bushes, does not include petunias because they're annual flowers and they die every year. So that's considered maintenance.
Okay.
So for purposes of what you're calling cost basis, it is the cost of the property, house, land, and any improvement. That's
Right.
the base, that is, for lack of a better term, the basis for determining gain or not having a gain.
Right. In
Okay.
95% of the cases.
Okay. Okay, so we're going to go over some other stuff again. Are additional living expense payments taxable?
The way additional living expense is not part of the disaster, and it's covered under a different code section. And so what happens is you've got the money that's coming from the insurance company, whether or not the insurance company is paying it to you directly, or if they're paying it to your landlord. It's the landlord does not have a contract with the insurance company, only you do. So you're responsible for the payments that the insurance company is making, whether it's to you or to your landlord. So you got to keep track of those. Now, that's the money coming in. Now we got to talk about the money going out. So the money going out is the money that's actually getting spent for the landlord, or maybe in the early days of the recovery, you're staying in a hotel, and so you had hotel bills, and because the hotel does not have kitchen facilities, you're eating meals out, so that would also be considered. And some of those, all that might be reimbursed by the insurance company. You keep track of these two categories until you get back into moving, until you've moved back into your house and you're done. You're no longer incurring additional living expense. Once you get to that point, then you tally the two columns up, and if the expenses are greater than what you received, you do not get a tax, you get no deduction for that. But if the proceeds exceed what you spent, then that excess money that's left over is taxable at that point in time.
Don, what about some folks who I know are basically renting their second homes? Their houses are destroyed, but they're renting their second homes. So they're the landlord and they're getting paid directly from the insurance company. What about
so
those?
the insurance, I've seen this a lot in many cases where the insurance company pays the fair rental value of the house that they lost, and they just live in this their second home. That's they have no expenses because they're living in a property that they own.
But is it taxable?
Well, again, that situation might change. They may live there for a while, and maybe it's a little bit inconvenient. I had people up north that lived in Santa Rosa, and they had a second home in Tahoe, so they kind of escaped to Tahoe for 6 months. But then they found that just wasn't manageable in terms of rebuilding their house, so they ended up coming back to Santa Rosa and renting a place. So they might. My point is they might still at some point start incurring additional actual rent. And so that would get charged against that money that they've already received. And just because the rental assistance that they're receiving from the insurance company might run out before they're actually back into their rebuilt house. So they might, in that rental situation, after they've moved out of their second home, they might end up eating up that money. But you have to wait until they get back into their final destination before you say, okay, now we're no longer incurring additional living expense, and do we have a gain or a loss?
So this relates, I think, more to the Edison case for those who are total loss homeowners, and that is emotional distress compensation taxable?
Okay, well, um, two answers, maybe three answers. One answer, not for state income tax purposes. Okay, for federal tax purposes, at this point, I have to say yes, but there's legislation in Congress that would extend legislation that expired at the end of 2025 that probably has a pretty good chance of going through. And if that goes through, then it's not taxable. If it doesn't go through, then it's taxable. And the really ugly part about that is that, let's say that you get $200,000 for emotional distress and you pay attorney's fees of $50,000. So you've got a net proceeds of $150,000. If it's taxable, you pay tax on the full $200,000 without deducting the attorney's fees. So it gets pretty disgusting. Again, not for state purposes, only federal, but that could be maybe 30% tax on that 200,000. So that's what, 60,000 plus 50,000 to the attorney, that's 110. So you end up out of that 200,000 netting 90,000.
And the federal relief you're talking about is the Federal Disaster Tax Relief Act, correct?
Yes.
Okay, and that's pending in Congress, as I understand it.
Yes, there's a whole bunch of provisions, and the provision that relates to the extension is really, it's kind of hidden because the title of that section is about 4 or 5 lines. Well, maybe not 4 or 5, but it's fairly long. And the actual adjustment just basically says, oh, where it says 2026, change that to 2036. It's very
Okay.
innocuous.
Well, we might have to talk to Joy about having a postcard campaign for that.
Yeah.
So next question, is there a required IRS form for reporting involuntary conversion?
No.
Okay. Do you want to expound on that?
Well, I mean, the IRS has got a whole bunch of requirements, but they have never been able to come up with a form. As a matter of fact, a few years ago, I was dealing with the person who handles the applications for extensions, and this was her first year handling that section, and we were having this nice conversation, and she said the first thing she was looking for was the form, and she says, I couldn't find a form. There's no form. And I said, yeah, there isn't a form. There never has been a form. I think it's too complicated an area for the IRS to create a form. I think if they did try to create a form, it would probably be 10 pages long.
Oh my God. Okay.
Now, on the other hand, because I only have to deal with a specific issue, I can get that all on one page.
All right. Well, you did cover this as well, but it bears repeating again. If the
Okay.
loss is not fully resolved, does something still need to be filed in subsequent tax years after 2025?
Well, I assume that in 2026 you're going to be working on rebuilding, buying contents, buying personal property. That all has to get reported. Excuse me, I said the wrong word again. Should be disclosed in that report of involuntary conversion that gets attached to the tax return. Every year during the process, basically you're filing, attaching the report of involuntary conversion to the tax return.
Okay, and this is an interesting one. Is SBA loan interest deductible against an involuntary conversion?
No.
Okay. So just a few more questions that have to do with strategic planning for taxpayers who are total losses. How does rebuilding affect the cost basis for a future sale?
Okay, so let's go back to my original example. So we had a $200,000 cost basis to start off with. We got $1 million of proceeds, and we got to exclude 500,000. So we have a $500,000 of net proceeds, $200,000 cost basis. We've got a $300,000 gain, and at that point we have zero cost basis left on our house. Now we go out and we spend that full $1 million on rebuilding the house. So that gets basically creates new cost basis of $1 million, but it gets offset with that $300,000 of deferred gain. So going forward, you'd have a cost basis of $700,000, which is basically the $200,000 that you started off with, plus the fact that we got to exclude $500,000, but we ended up spending it. That ends up creating new cost basis. So that's how we get to $700,000.
Okay. What happens if the homeowner rebuilds and later sells the property?
Well, it depends upon when they resell. If they rebuild and they immediately sell the house, then they have not replaced the property because they have not moved into and they have not made that property, use that property for personal use. And I was kind of being careful there because you don't actually have to move into it. You just have to hold it as personal use real estate. So somebody who rebuilds and sells, well, it was a speculative construction, and that doesn't count. Some people might say, well, geez, I'm going to rebuild and then turn that into rental property. Well, they have not replaced their personal residence. They've created a new type of asset, rental property. They have not replaced the asset. So you have to be very careful that you're actually replacing the asset that you lost and using that asset. Now, how long do you have to use the asset before you can change the use? I would say, probably a couple of years, a couple of tax years. So if you rebuild and you move into it in June of 2027, and then you decide in January of 2028 to rent it out. Well, you're always entitled to change your mind, but that's about a year and a half, two tax years later. You're entitled to change your mind, but don't change it in 2027 when the day after you finished rebuilding.
Here's a little tougher question. How should homeowners calculate cost basis for replacement property after disaster?
Well, all of the costs that they're incurring to rebuild, which would include permits, engineers,
John, I'm talking
geologists.
about people who've opted not to rebuild but are purchasing elsewhere.
Oh, so they buy a new home. It's the purchase price of that home, and they might they move into the house and they decide to spend $200,000 remodeling the kitchen and adding a bathroom in the bedroom, and that would go into the calculation of their cost basis, less whatever deferred gain that they had from the fire loss.
So there is a little bit of a break for those folks as disaster victims?
Oh, there's a
If
lot
they,
of break. Yeah. I mean, it's
okay,
basically you don't have to rebuild. You can buy something. You just have to spend as much. You just have to spend an amount equal to the proceeds. And I've referred people back to the example in the prior presentation where I showed that you actually can use the money that you spend on personal property after the fire and allocate some of the gain to that personal property and unload some of the gain onto that personal property.
okay. How are settlement payments from SCE or insurance tax?
Well, I mean, the insurance is clear. I mean, you're electing to defer the gain, and as long as you spend the money on rebuilding or replacing, then you're okay. As to the settlement from Edison, you're gonna have different categories that you've received: real property, contents, maybe additional living expense, possibly something called prejudgment interest. There's another thing that might be that Edison pays some amount for attorney's fees on all of the insurance qualify, the real property, the personal property, and the ALE payments. And then there's the emotional distress. Now, the money that is paid or that's calculated for that Edison is paying towards attorney's fees, those attorney's fees get allocated back over to the items. So if let's say that you got $500,000 for real property from Edison and $200,000 for contents, so you got $700,000, and they pay 10%, $70,000 of attorney's fees. Well, $50,000 of those attorney's fees would get added to the $500,000 for real property, and 20,000 would get added to the contents. Now, on the other hand, you're actually going to pay real attorney's fees to your attorney, and that might be 25%. That 25% is going to get calculated on the $550,000. So whatever that works out to, 125 plus 12,000, 137,500 attorney's fees will get deducted from the $550,000. And that will be your net proceeds that you have to reinvest.
So
What
here's
about
a
the-
tough one.
Oh, sorry, sorry. Let me clarify something. So what about the payout for emotional distress?
The emotional distress is taxable. And again, you're paying attorney's fees on it. But I talked about this earlier. You pay tax on the gross amount. But again, for state purposes, as long as the settlement occurs before 2030, which I presume it will, there's no tax implications for any of the SCE settlement payments. If the legislation gets renewed, then the emotional distress money would be totally tax-free.
Here's a tough one. What must be reported annually to preserve involuntary conversion treatment?
Well, you're reporting your story. You're starting out with your cost basis, your proceeds, your money that you're spending on replacement property, and that all gets reported both cumulatively and the current year. So how much did I receive in insurance money this year? How much did I spend on replacement property? How does that fit in with the added to the last year in terms of the cumulative amounts? And then you deduct your 500,000 or whatever you need of the $500,000, and whatever's left over is your gain. And the gain plus your original cost basis is the amount that you have to reinvest, and that has to be accounted for. Again, how much did you spend this year? So it's a complicated form, not easy.
So with relation to cost basis, many of us total loss homeowners don't have any of the documentation to show what we spent on improvements for the property. It's torched. So
I
how
understand.
what does a homeowner who's a total loss do under those circumstances when you're trying to convince the IRS that you've spent X amount in improvements for your property that doesn't exist anymore, and neither do the records?
Okay. Well, first we have to there is an old case called that created what's called the Cohen rule. There was a back in the 20s and 30s, maybe into the 40s, there was a song and dance man called George M. Cohen who got robbed by his manager and left him without paying any taxes, and George was left holding the bag. And so what was worked out in court is, well, George, we know that we have the records to show that you were in Buffalo for 3 nights, and obviously you needed a place to stay. So we know how much you got, and we know how much the room would have cost for 2 or 3 nights in Buffalo. So we'll deduct that from that. So a lot of estimation, reasonable estimates. So that Cohen rule comes into play here. So what did you do? So I suggest to people that they sit down and make detailed notes of what they did to the house, and not just, oh, we spent $500,000 improving the house over 5 years. No. What did you actually do? Well, we spent such and such an amount on remodeling the kitchen. We added a bedroom, and that our best memory is that we spent so much for that. Oh, and then there was the bathroom. Oh, and then there was the hot tub that we put in the backyard. So as best you can, try to detail all of those modifications, improvements that you made. Now, as to the original purchase price, there's some cases where this doesn't quite work well, but in 99% of the time it works fairly well. We can go to the internet, to Zillow, to Trulia, Realtor.com, Trulia, whatever, and we can find out what you paid for the house. Now, that doesn't include the closing costs, but at least we know that, okay, in such and such a year, the house was sold for $150,000 in 1985. Well, so we can use that as the cost basis of the house to start off with, and then add the improvements. Now, if you have any pictures, or you have friends or relatives that took pictures at your house over time and can show aspects of the house. I mean, maybe they're taking a picture of you, but your house is in the background, or that brand new kitchen is in the background, or maybe the old kitchen and the new kitchen. You have pictures of that. That all is helpful information. Not absolutely necessary, but if possible, it'd be helpful. Also, if you can get pictures like that, then you might also see things in the pictures that say, "Oh, I forgot about that piece of important vase that was sitting on that hutch in the dining room." And now you can add that to your personal property claim. So those pictures can be very, very valuable and useful. But it's a lot at this point. It's based upon the honesty and the estimates of the taxpayer. Now, if you bought the house for $150,000 in 1978, and you spent $700,000 on it over 25 years, and a lot of it was recent, that might not be. I'm not suggesting anything specific, but that in itself would not necessarily be something that I would worry about, because prices go up, and what it costs to add a room 25 years ago is a lot less than it would cost to add a room today.
Okay. So I am going to wrap it up. I'm sorry. Go ahead, Cherry.
Sorry. John, you mentioned something about the closing cost. Is that added to the cost basis of the house?
Yes.
Okay.
So, escrow fees, title insurance, things like that.
Okay, and that information is not in Zillow, so
No, that's not in
then,
Zillow.
right, okay, so it's not just the purchase price, but all the closing
Right.
costs. Great,
Right.
thank you for clarifying that.
Yeah. So I'm going to wrap up my portion. I've asked the last question that we've had on the roster, but I am going to remind people, Cherry's going to take it from here on standing home issues, but ask that the total loss people hang in there, listen to this presentation as well, because it may answer some questions you might otherwise pose. So Cherry, please take it away.
Great, thank you, Wanda. So for standing homes, this applies to partial loss or smoke damage.
Right.
Let's ask the yes, no questions first. Can homeowners with contamination or smoke damage, but no structural loss, still claim a casualty loss?
Possibly.
Okay.
Depends upon the proceeds.
So does that mean, again, do not claim any casualty loss in 2025 because we don't know
Correct.
the proceed yet, but once we know all the proceeds, then we can still claim the casualty loss if we do have one.
Yeah, the trouble with the standing home, the smoke damage, is you can get an appraisal of that property before the fire, but I really question how an appraiser is going to value a house with smoke damage. You look at two houses next door to each other, two houses next door to each other. They both have smoke damage. They're both identical homes, but one may have more smoke damage than the other. I don't know how an appraiser can come up with a fair market value of that home after the fire. I think in most of those cases, they're going to have to use a different methodology for computing the loss. It's called, instead of using the appraisal method, that they would use what's called the cost of repair method. So on the fair market value computation, usually we have the fair market value of the property before the fire and the fair market after, and you deduct the after from the before, and you come up with the decrease in fair market value. When you're using the cost of repair method, you do the math in reverse. The cost of repairs is the loss, and you deduct that from the fair market value before the loss to come up with the fair market value after the loss. Now, one of the problems with the cost of repair method is there are several. One is it's not the estimate of the cost of repairs, it's the actual cost of repairs. So you don't know those until you've actually completed all of the cost of repairs. So you have to wait until you're done. Additionally, a lot of times in repairing a home, taxpayers will add something. Maybe not in the smoke situation, but who knows? They say, well, while we're out of the house, let's add a bedroom, or let's make some improvement that's not a repair, that's an actual improvement. One of the restrictions on the cost of repair method is that you can only include in the cost of repairs those costs that get you back to the original property, the way it looked, the way it existed prior to the loss. So I don't know if maybe part of the loss was that the kitchen was severely damaged and all the kitchen cabinets have to be replaced. So now when you're replacing the kitchen cabinets, the old kitchen had ceramic tile, and I say, well, that's really dated. Let's upgrade to granite. Well, granite is an upgrade, so you can't include it, and you can't include the differential between the cost of granite and the cost of ceramic tile. For the cost of repair method, your cabinets just don't have tops on them because you didn't put the ceramic tile back in. So it gets really very complicated. I had one a number of years ago, and just the tax disclosure, because we detailed a lot of stuff in there, and I think it was like 5 pages long, because they did make a lot of improvements to the house that we had to show that we were not including them.
Okay, so it is acceptable, but just very complicated.
Yes.
Got it. So then for 2025, in that case, since many of us, we don't even know what to do yet, what kind of documentation do we need to gather? Do we need to report then?
Well, my suggestion always is to start off, if you're not claiming a loss, which you would not be claiming a loss in 2025, that you start the documentation as if you're doing an involuntary conversion deferral, because that way you're accumulating all the information, and when you're done, maybe in 2027, and you see, okay, geez, it looks like I do have information to be able to claim a loss, then you've accumulated and accounted for all the data that needs to go into the loss calculation.
Okay. And the document for the involuntary conversion together is all the expenses that we incurred and say if we get any payout.
Right.
Right. Okay. All right. Next question is, are unreimbursed ALE deductible in partial loss situations?
No.
Okay. Should homeowners disclose pending disaster claims on current tax returns?
Well, they should generally file a report of involuntary conversion, but they don't have to report as part of that, they don't have to disclose as part of that report to say, oh, we have an outstanding claim against the insurance company for $100,000. No, these are all prepared on a cash basis. What the actual cash is received, what the actual payments have been made.
Okay. And if insurance only partially reimburse remediation, can the unreimbursed portion be deducted?
Possibly.
Okay.
But again, it might be reimbursed by the lawsuit against Edison. And even if the Edison lawsuit money, if the tax law comes through, one of the provisions in the existing law that would be just renewed is you can't create, if how do I want to say this? If you have proceeds that would eliminate that, you in effect you get reimbursed by Edison for that excess that you did not get paid for by the insurance company, even though technically those proceeds are tax-free, you cannot create a casualty loss by excluding them.
Okay, in that case, then you might end up having the involuntary conversion gain.
Possibly.
Yeah, okay. And I think we
Well, you
answered
wouldn't necessarily, I'm sorry, Jerry, you possibly wouldn't have a gain, but you'd have a net zero.
and that's okay. And this, we might already answer this, but it doesn't hurt to hear the answer again. For any losses that aren't covered by lawsuits, such as SCE or insurance, do we count them in our cost basis of the house?
Well, they're not losses then.
The losses that aren't covered by SCE. So for smoke remediation, sorry, for smoke damage house, there I think what this one is coming is that a lot of the work insurance is not covering. For example, insurance is only paying for wiping down clean, but some drywall needs to come down. So homeowner may end up having to pay for it themselves. So
Okay.
that kind of loss,
Well-
do we count them as?
Well, okay, again, I wouldn't call that a loss. That's a cost of repair, and that does get added to the cost basis.
Okay, yes, the cost of repair. Okay, got it. Thank you. So now let's go into some more in-depth clarifying questions. Let me see. The extent of the damage is still unclear. We are still waiting on more test results, contractor estimates, and insurance outcomes. How do we account for losses of those unknown value in our 2025 tax return?
Well, if we don't know what the loss is, we can't report it.
So again, then we are just reporting what we know that
We can't disclose it. Yeah.
Yeah. Okay. And how should remediation costs be treated for tax purposes?
Well, the proceeds come in as a reduction in the cost basis of the house, and the remediation costs get added back to the cost basis.
Okay. And how do insurance proceeds affect the tax basis of a standing home?
Well, they reduce the cost basis.
Okay. It will be still treated the same as the total loss cases, right?
Right.
Yeah. Okay.
But
How
you're not getting into a gain situation probably.
Yeah.
I mean, maybe you have an $800,000 cost basis and you got $200,000 from the insurance company for remediation. So that brings your $800,000 down to $600,000. And then you spend $300,000 on actual remediation. So now you got the $600,000 plus the $300,000 that you spend on remediation, and now you've got a cost basis of $900,000.
Okay. And how does partial reimbursement affect future capital gain if the property is sold later?
Well, when you're done with all of the ins and outs, you have a new cost basis, and that becomes your cost basis going forward.
Mm-hmm. And that
instead of the deferred gain.
And that 2-year, 4 year still applies here. You mentioned earlier about
the thing is in the smoke damage, I assume that the damages are not greater than your cost basis. So the 2 years and the 4 years doesn't start because you don't have a gain.
That's correct. Right. Got it. Thank you. Oh, this is interesting. Yes. If the property is owned in a family trust, how does involuntary conversion apply?
Well, family trusts are ignored entities for tax purposes, so it has no effect.
Okay,
Now,
so it would be
if it's in a qualified personal residence trust, then that's a whole new story. I've actually got one call in the last week on this, so I bring it up, but they are kind of rare.
okay. So I think for family trust, this just means like in a trust, in a estate trust.
Right,
So,
a regular living trust, yeah.
Right. Yes. So then it will be, we will just treat it the same way as without a trust.
It's an ignored entity, and so it's John and Jane's family trust, but John and Jane file their tax return, and that's where the report of involuntary conversion or the any reporting gets done on John and Jane's tax return.
Okay. Now, what happens if a trustee passes away during the rebuild or reporting window?
Oh, this is way beyond the scope of what we can talk about tonight.
Okay.
But it is very complicated, and I actually got I think 5 cases right now that I'm dealing with, and it is very complex, and there's a lot of tax law tax court cases that go back as early as the 1950s dealing with this, and the tax court and the IRS totally disagree, and the IRS and the Treasury Department that oversees the IRS, the Treasury Department and the IRS disagree. So it gets really interesting, but really complicated.
Got it. Okay. And the last one I have here is what happens if the home is sold after major repairs are completed?
Well, if you just complete the repairs and then you sell the house, then you didn't replace your personal use residence. You built or repaired a speculative house. So you did not replace the property. But if it's a smoke damage one where you had no gain, then it really doesn't make any difference.
Okay. And is there a timeline as to when you sell the house to get the tax benefit? To get isn't that like primary residence? You live there for 2 years of the past 5 years, you get some tax benefit. Does that apply here?
So now let's say that you use your $500,000 credit exclusion against the insurance proceeds. You rebuild the house, you're back in the house, and so now your that 2-year clock is starting again, and it probably you have to wait for 2 years after. Hopefully that's 2 years. Well, not hopefully, but you have the 2-year clock that would start for the $500,000 exclusion doesn't start until 2 years after, at least 2 years after the date of the event. So the date of the event was January 7th. You move back into the house in sometime in let's say the end of 2026. So less than 2 years. So your 2 years starting that count to get your new $500,000 wouldn't start until January 7th of 2027.
Oh, okay. Now, what about for those people who want to go down to the stud and they might be in a lawsuit, so they won't know until end of 26 to get their settlement from insurance, then they rebuild. So that might be end of 27, 28. How does that work?
Well, then they're not moving back in until 28. So that's more than 2 years after the fire. So if they move in January 1st, let's say of 2028, then they're 2 years towards getting their another $500,000 exclusion would start on that 2-year period would start on that date.
On January 2028.
Right.
Okay. So meaning they have to sell within 2 years after 2028
Yes.
to get that 500.
Because now they're living, they have to demonstrate that they've lived in the house for two new 2-year period.
Yes. Okay. Got it. Yes. Thank you. So with that, I'm going to turn it back to you, Wanda, for.
Oh, can I since we're talking about the $500,000, there's something that just hasn't come up in the conversation, but I'd like to just interject it here. Let's say that you bought your house exactly a year before the fire, and you moved into the house January 7th of 2024. And now you've got the fire on January 7th of 2025, and you have a gain. So what about that $500,000 exclusion? Well, there's a special provision that says this is an unforeseen circumstance, and so you've lived in the house for 1 year, and you've lived in 1 year, which is 50% of the 2 years, so you can actually use 50% of the $500,000 exclusion. Does that make sense?
Sorry, I was looking at the chat. So
Okay.
It does make sense, John. It made sense to me. Thank you.
Okay. Okay.
Thanks. Yeah, so
I
back
mean,
to you,
I've got to, I was talking to somebody, they moved into the house 3 weeks before the fire. So whatever that, 21 days out of 731 days. Well, whatever that percentage is, they actually get that much of their $500,000 exclusion.
It's not much.
It's not a lot, but it could be 10, 15,000. No, probably not 15,000, but maybe $10,000 for a joint.
So speaking of hearts bleeding for people, mine does bleed for condo owners because that's a whole nother set of hoops and things that they have to go through. But I do want to cover just quickly some basic things for the people that are condo owners so that they get the benefit of your expertise, John. So we have condo owners in Pacific Palisades whose situation is very different. Some condo HOAs have voted not to rebuild. Others are still waiting for a full cost analysis before they vote. And HOAs that don't rebuild might wait a few years before they sell the land, which doesn't help the individual condo owners very much in this situation. So what do condo owners need to know generally?
Well, the problem with condos, one of the math problems with condos is as an owner of the condo, you've got the cost basis, but you don't have the insurance proceeds. And if the association is rebuilding, they're incurring the actual rebuilding costs. So your cost basis hasn't gotten affected. So you don't have a loss. Now, in a situation where the association has decided, hey, we're not going to rebuild, and they've distributed the proceeds from the insurance on some pro rata basis, well, then those proceeds get treated to the individual condo owner as if they were proceeds that were received from the insurance company for their real property. The same would happen with the ultimate sale of the land. Now, the problem with the ultimate sale of the land is that if that land is sold, if the date of the fire, let's say the date of the fire for that particular condo is January 7th of 2025, if the land is sold after January 7th of 2027, then any gain arising from the land sale cannot be used in calculating the $500,000 exclusion. If the land sale takes place before January 7th of 2027, then that proceeds can be used in terms of calculating any $500,000. Now, their situation might be that just the proceeds from the fire insurance distribution plus their own insurance policy for their own unit might put them in a gain position, in which case then they can use their $500,000 against that if they've met the 2-year requirements.
So let me ask some questions that might put a pointed focus on this for these people, again, who my heart goes out to. If a condo unit is uninhabitable but not destroyed, does that change casualty loss treatment?
I guess the question is what it means is by uninhabitable is that there's a term that is applied in these situations that comes into question with regard to the use of the Section 121 exclusion, that $500,000. One of the requirements is that in order to, and I may have made a mistake in terms of when we're talking about the smoke damage homes. I want to go back just for a second. On the smoke damage homes, I doubt that they would qualify for the $500,000 exclusion because there's a requirement in order to claim the $500,000 exclusion that the property is completely destroyed. Now, on the smoke damage, and I'm sorry for going back, but on the smoke damage ones, if it's a situation where basically the house has got to be disassembled to get rid of all the contamination, then that would possibly qualify as completely destroyed. Now, on the condo, coming back to the condo situation, if it's uninhabitable, I assume that means that it's going to have to be torn down, in which case that might qualify as completely destroyed. But the only impact of whether or not it's completely destroyed or not completely destroyed is whether or not the property would qualify for the $500,000 exclusion.
Okay, so that'll be key to the determination.
Right.
Are HOA loss assessments for rebuilding tax deductible?
No, but they're in effect, they would qualify as so presumably you've got coverage from the insurance company, so you get $50,000 from the insurance company, so that becomes part of your proceeds for basically under coverage A, and now you pay that $50,000 to the HOA, so that becomes a reinvestment, a rebuilding cost.
What are
So
the
they end up
tax
offsetting each other.
Okay. What are the tax implications for condo owners whose HOA has not yet decided whether to rebuild?
Wait and see.
Yeah. What happens if an HOA votes not to rebuild and instead sells the land years later?
Well, again, you probably don't have, you may not have a gain because a lot of the gain may be tied up in that land sale. So their 4-year replacement period hasn't started yet until the land sale.
Then what happens if an HOA votes not to rebuild? I'm sorry. How should individual owners handle tax filings when insurance claims and lawsuits are still unresolved?
Filing a report of involuntary conversion, tell the story year by year, and then when you finally come to some resolution, then you either have a gain that you have to deal with and reinvest, or maybe at that point you come up and you have evidence that you have a casualty loss, and then you have to go back and maybe get appraisals.
How does master policy insurance interact with the owner's individual policy for tax purposes?
Well, it really doesn't. The master policy, like I said, the HOA has the policy, but they don't have the cost basis. The individual owner has got the cost basis, but they don't have the proceeds. So it's and basically the HOA is basically responsible for getting them back, providing them with a replacement shell that they can go back and do their individual special improvements that they had.
So John, we still have quite a few people on the webinar. I don't know if anyone is a small business owner who's been affected by the fire, but there are very few questions that I have in that regard. So I'm just going to ask them real quickly for those who are on who might be affected personally or know someone, and it might be helpful all around in that respect. And this relates to small business owners again. Are SBA loans taxable?
No.
Is SBA loan interest deductible?
It's probably deductible.
This is for small business
expense.
Okay. How are business losses spanning multiple tax years treated?
Well, it's very similar to the residents that you can't deduct a loss until you have all the facts and you've settled all the claims. The problem with the business owner, well, it depends upon the kind of business. I mean, if looking at say my kind of business, which is basically a service business, I pay rent, so I'm not responsible for the building, but I have a bunch of assets, contents, furniture and fixtures, and so I would be getting paid for that, but I probably have no cost basis in those assets because I've probably written them off or depreciated them. So whatever I get is probably gain, and so now I've got 2 years to replace that property. If in addition, let's say that I have a hardware store. Well, now I've got, in addition to my furniture and fixtures, I've also got inventory. And the real problem for the owner of a business with inventory is that that's separate from the furniture and fixtures. And depending upon the inventory method that they used, they may, if they use something called LIFO, which is last in, first out. So it's kind of like think of a pickle barrel, that I've got pickles in the pickle barrel, but theoretically, I'm always selling the pickles on the top. Then all those really cheap pickles that I bought years ago that are way at the bottom of the pickle barrel, now all of a sudden they no longer exist. And so now I've got and I get proceeds for those pickles that are at the bottom of the barrel, but they only cost me 10 cents, and now I'm getting $1.50 for them. And so I've got a huge gain, and I've got to go out and buy a new barrel, a whole barrel of new pickles, which maybe is going to cost me $1.50 or $2 per pickle to replace. But giving up that LIFO base in the process, and that can be a tough thing for a business owner.
So last small business question. What annual reporting is required for business involuntary conversion?
Same thing, report of involuntary conversion.
Okay, which does not exist as a form with the IRS.
Correct.
So last session, John, we had you on for an hour and 45 minutes. And there's still quite a few people hanging in there. And we have 44 questions. We're not going to be able to get to all of them. John, can you hang in there until 7:45?
I'm okay. I just have dinner and sleep for the rest of the evening schedules.
Okay. And I looked at some of the questions, and a lot of them are really good ones as a follow-up to what you've presented. So, Cherry, how do you want to do this? Do you want me to ask them?
Well, I just ranked the most voted, so let's go from there. Yeah.
All right.
So, so let's go with Deborah's question. Part of the SCE offer includes non-economic damages, that is pain and suffering. Also, a direct claim premium to resolve any future litigation. Is this premium taxable?
I haven't come to a real conclusion on that because it's not eminent yet, but it might be treated the same as the. It depends on how it's structured, how it's defined. It might get spread pro rata over the real property, the contents, and the ALE. And the stress, or it might just be considered taxable. But again, if the tax law goes through, that additional payment would be non-taxable. And for California purposes, it would be non-taxable.
So meaning if for the whole SCE payment, if anyone is receiving it this year, before the tax law goes into effect, part of that is taxable, part of that is not.
No, I mean, if the tax law gets through, all they're doing is they're saying the expiration date that you have to get payments made before before January 1st of 2026 is getting changed to you have to get payments before January 1st of 2036. So the fact that you got settled with Edison in February of 2026 and the law gets passed in November, you're covered.
Okay, perfect. All right. The next one is my rental home was destroyed in the Eaton fire. It was said previously that it has to be a qualified replacement property. So if I rebuild, it has to be a rental again. For how long do I have to rent it? I would like to sell as soon as possible.
Well, I mean, you can sell it as soon as possible, as soon as you finish it. But it's, whatever your adjusted cost basis net of your deferred gain is, that's going to be your cost basis against the sales price.
I think what that question is asking is maybe if there's any tax benefit if you hold on to the property for X number of years.
Well, I mean, I don't know that there's additional tax benefit. The only difference would be if you're renting it out, then you'd get more depreciation, which would reduce your cost basis, and you'd have a bigger gain when you go to sell it. But maybe you'd get more money also at a higher price.
Okay. This one is from Pali. Palisades fire total loss, section 1033 election question. Is it just a statement of intent that should be included on the 2025 tax return and then annually until reinvestment is complete?
Well, first of all, I would not make a 1033 deferral election on a tax. I would report what happens in 2025 on a report of involuntary conversion, but I would not include if there's no gain in 2025, if the gain starts happening in 2026, I would not make an election on the 2025 tax disclosure to replace the property. Because once you make that election, you cannot revoke it, and you might change your mind as to what you want to do. So you want to hold off. If you don't have a gain, then you want to hold off actually making that election. So if you have no gain in 2025, you disclose the facts, but you don't make an election. Now in 2026, you have a gain, and now you decide, you know what, I think I just want to pay the tax and move on. Well, then you can do that. But if you made an election in 2025 to replace, then you're stuck with that election and you can't sell the property for 4 years.
Okay. And this one comes from a tenant because he or she missed whether ALE payout is taxable for tenants. And is ALE payout different for tenant versus total loss versus smoke damage? I think they are all treated the same, right?
Yeah, well, the problem with the tenant, with a home, you still have the costs related to the old the property while you're living someplace else. With the tenant, probably they're not paying rent to the old landlord. They're now just paying rent to a new landlord. Now, they may be paying more rent to the new landlord than they were paying to the old landlord, and I would say that differential would be offset against the money that ALE proceeds that they get. So if they were paying $500, well, make it simple. If they were paying $500 a month rent on the old property, and now they're paying $750 a month on the replacement property, and they're getting $300 a month from the insurance company, well, that's $50 more than what they were when you deduct that from the $750. They're making $50 more on that money than they were paying in the old property. So that might be taxable in the future.
Okay.
John, Cherry, could I ask a question? I think that would be really relevant to those who are at or approaching retirement age with respect to this disaster. And that is, can disaster-related losses offset other income, such as IRA to Roth conversions?
The answer is yes, but the thing, you got to be careful about that because you got to make sure that you're actually going to get the casualty loss. I mean, I'm talking to somebody where they immediately after the fire, they immediately converted several $100,000 of their IRA into a Roth IRA, and then all of a sudden they were faced with the fact that they don't have a casualty loss yet. But they're stuck with that IRA conversion, and so now they're having to pay tax on that IRA conversion, and they don't have the offset of the casualty loss. They got to
So
be
it's
very
not,
careful.
yeah, so it's not until you have exhausted all means of income that you could actually do a Roth conversion
Right,
and have that be offset by the disaster,
right.
right?
Very good. So this one is from Joyce B. If our dwelling A and B insurance proceeds received in 2025 is less than the cost basis of the home, aka no gain, and we expect to receive a settlement payment from Edison via litigation, do we start documenting the involuntary conversion on our 2025 tax return or wait until there is an actual gain?
Start with the 2025 return.
Okay. Next one is from Vicky. My primary residence and contents were destroyed in the fire. I received payments for the limit of my personal property and was not asked to itemize. I think my personal property content was probably worth more than the funds I received. Can I take a tax loss on the value of my personal property that was in excess of the insurance received? Or is that not worth the effort?
Well, without getting into details, I find that it is very tough to come up with a casualty loss on personal property because you bought something 5 years ago, and the replacement value, the replacement cost today is much higher. And maybe you didn't get full value for it today, but maybe you got more than what, and you maybe even didn't get as much as you paid for it, but that property is not worth as much. It's gone down in value. So if you've got a jacket that you paid $500 for, an expensive jacket, I don't know, $500 for 5 years ago, it's not worth $500 at the date of the fire. It's maybe worth 150. Now, the one thing that you want to be careful in terms of looking to see what the value of these items might be is you do not use thrift cost values. They are not applicable because you never intended to give it away to a thrift store. It still had value to you, so it probably had a value greater than the thrift store value. But that doesn't mean that you've got a casualty loss. You probably don't have a casualty loss. And if you don't, there's a safe harbor calculation that basically involves looking at the replacement cost and then adjusting that for the number of years that you've owned it up to 9 years, 9 out of 10 years. So if you've owned something, the replacement cost is, let's say, $1,000, and you've owned that item for 6 years, then 60% of that $1,000 you would take off, and your cost basis would be considered to be $400. And $400 cost basis against a $1,000 proceeds, that's a gain, not a loss.
Jerry, can I ask another question? And this This comes from a personal standpoint, but it relates to standing home victims because I've heard from a lot of people I know who are getting advice from significant tax experts whose homes are still standing and there's fire, there's smoke damage and that sort of thing. And they are taking substantial casualty losses for 2025, calling it diminution in value. And having heard you speak previously, it's kind of making me nervous. Can you speak to that, whether or not that's appropriate?
Well, I question how they're coming up with the decrease, how they're coming up with the value of the home after the fire. I mean, I understand that after the fire, with all the debris and the smoke damage, etc., that it's not worth as much as it was the day before the fire. But I don't understand how an appraiser can come up and value that. I mean, nobody's going to buy a smoke damaged home.
So wouldn't such a loss being taken for 2025 be dependent upon whether or not you were selling the property or not?
Well, possibly if you're but again, who's going to buy it?
Right.
That's
So then
the
that's
real
your
issue.
loss. Wouldn't that be your loss?
Yeah. Well, the thing is that let's say that you do sell it, but I really, again, I question whether or not there's any if there's a sale of a smoke damaged house, then I don't know how. I'm sure that the person buying that house is paying a huge getting a huge credit for the value, and probably in excess of what the actual decrease in value is. I mean,
so let's back up a second. So let's say, for purposes of my example, the only thing to base the loss on is this diminution in value for a house that is already standing and is being remediated. Under any scenario, would that be appropriate?
Again, I don't know how anybody could come up with the decrease in value.
Okay.
That's what I really question there. And that could be really an easy pickings for the IRS. And by the way, the one area that the IRS seems to hit in these situations, they don't seem to audit the report of involuntary conversion. At least in the 32 years I've been doing it, I've never had an audit on one of those. But I have seen situations where people, not my clients, have had claim casualty losses, and then they come to me because all of a sudden the IRS is questioning the casualty loss, and it's in some. I had one case recently where I looked at the situation and I looked, there was a 2021 loss calculation, and I looked at and talked to them about what had actually happened over the ensuing years. And I said, you know what? The IRS is doing you a favor, because if you actually won on that loss, you'd end up having to recover it in 2025 and pay a lot of taxes back. So you're better off letting them reverse that loss, paying a little bit of interest, and be done with it.
Great.
Thanks, John.
Okay. Should we go through a few more questions?
Sure.
Yeah. Okay. This one comes from. Sorry. This one comes from Tony. Can you confirm that if we had a casualty gain in 2025, that even if we are still waiting for the rest of the insurance or other settlements, that we do need to file the casualty gain in 2025? There is confusion about the disaster year /4 years. and whether we should just not build out the 4684 this year and then wait, and can wait the 4 years.
Okay, if you have a disaster gain, you do not want to use the 4684 because you're going to pay taxes on it if you use that form. Instead, you want to report it as a deferred involuntary conversion gain. So it gets reported on a report, it gets disclosed on a report of involuntary conversion.
Okay. Can you explain what to do on the return to note that the disaster claim is pending?
Well, again, that's part of, you don't have to really disclose that it's pending. If you have, in the rare situation where you've received absolutely nothing from the insurance company in 2025, then I would include a note that says, we had a fire, give some facts related to the fire, and we'll get back to you. I'm kind of colloquializing the language, but we will get back to you when we have additional information.
Okay, so it's kind of like a statement that you put in along with
Right.
your.
But if you've received any insurance proceeds, then you need to disclose them in a report of involuntary conversion.
Okay. If there is no form for casualty loss, what is IRS form 4684 for? 4684.
Yeah, 4684 is for casualty losses. And if you have a casualty loss, you can actually report a casualty gain on the 4684, because if you put in proceeds, if you put in the cost basis and you put in the proceeds and the proceeds are greater than the cost basis, that'll be lines 2 and 3. Then on line 4, the computer will automatically compute the gain and you'll pay taxes on it. And so you don't want to do that. If your cost basis is less, if your cost basis is greater than if your cost basis is less than your proceeds, you don't want to use the 4684. If your cost basis is greater than your proceeds, then the question is your case settled? Are you done? Are you finished? Are you going to collect any more proceeds? If you are, then you're not entitled to claim the loss at this time.
Okay. When you say taxable, some of these items are taxed at the capital gain rate, while others are taxed as ordinary income, right?
Yes.
Okay. Situation in residence, smoke and partial damage home. We are renting because we cannot live in it, which insurance is helping with. After we fix it, we may rent it out for a while before we move back in. Does this cause a tax issue?
It might. I'd have to know more about that.
Okay. ADU. I lost my home and an ADU that was being rented at the time of the fire. How do I handle fact my lot was a hybrid?
Well, you've got two transactions. You've got the personal residence involuntary conversion, and you've got the ADU involuntary conversion. And the ADU, you've only got the cost of the structure itself, less any depreciation. So you might not have a gain on the main residence, but you might have a gain on the ADU. And once you have a gain, you've only got 2 years to replace the ADU, as opposed to the 4 years on the residence.
If we take the 500,000 for tax year 2025, we built and moved into it in 2027, can we take another 500,000 in 2029? I thought can only be deducted every 5 years. Please clarify.
Well, no, there's not a 5-year rule. There's a 2-year rule. So in that case, since the loss was on January 7th of 2025, you'd have to, the new 2-year period would not start until January 8th of 2027. So you'd have to be in the house from January 8th of 2027 to January 8th of 2029 to get the 500,000.
So Cherry, it is 7:45, and since John only has time tonight to eat and sleep, we probably should let him go do
Yes.
that.
I'm okay. I'm okay.
Yes.
And quite a few people have dropped off, so it
Okay.
might be good to wrap it up. And as I said in the beginning, Joy is going to be sending out some materials on Tuesday. I'm sure there'll be a link to this program as well. And there is a possibility there may be another one in the future. So I'd hold tight for that. But
I'm available.
thank you everybody for your participation. And like I said, I know these are tough issues. And I hope that tonight, as well as everything else John has done for us, has imparted some sense of calm in understanding this a little bit better. So I hope you all have a wonderful evening.
Yeah.
Thank you.
Thank you, John.
Thank you all.
Thank you, John. Amazing stuff as usual. Thanks, Cherry. Thanks, Wanda. Thanks,
Thank
Sandra.
you all. Bye-bye.
Take care, folks. Bye-bye.
Thank you, everyone.